Hello. In this video, we'll be going over debt instruments called available for sale. We've learned that there are three types of debt investments that a corporation can enter into. The held to maturity is when they buy a bond or a note as an investment, and they have intent and ability to hold that bond till its maturity date. The next type of debt investment that we learned about is the trading security, which are very short-term bonds or notes that a company holds, and they actively buy and sell them. And the longest period that a trading security is held is 3 months, and it's typically classified as a current asset on a company's balance sheet. The last type of debt investment, and this is what this video is about, is called available for sale. And available for sale is kind of a catch-all category for the type of debt investment a company might make. And it is, if it doesn't fall into your held to maturity category, or it doesn't fall into your trading security, then it's considered to be available for sale security. The available for sale security is carried at the balance sheet at their fair value, similar to the trading security. However, any unrealized gains and losses are recognized in other comprehensive income, and which is part of your shareholders' equity, but does not affect your net income on your income statement. You should recognize this amortization schedule from previous videos, and if you don't recognize it, please go watch the video called Effective Interest Method, because I go over this in detail as to what it means and how it's calculated. But we're working on the same example throughout all these videos, where we acquired a bond on July 1 at a discounted price of $666,000. The face value of the bond is $700,000. And this amortization schedule shows the discount balance and how it is amortized down while the investment account is increases to its original balance of $700,000. And we're going to be working with this example, specifically the 12/31/27 balance. That's why I included this slide in here, where at the end of 12/31/27, this particular bond, the amortized cost on the balance sheet is $671,000. So I want to work through this same example we've been working through in previous videos, but now we're going to assume that our investment is an available for sale investment. And what it says is Masterware issued, which means they sold these bonds to United, which is the company that has the investment, on July 1 and the amortized cost on 12/31/27 is $671,000. But we learned that the fair value of the bonds on 12/31/27 is $714,000. So the amortized cost is $671, the fair value is $714, and so we need an adjustment to increase the balance of this investment on United's balance sheet from $671 to $714. So we need to increase it by $43,000. And the way we do that is we introduced a new balance sheet account called Fair Value Adjustment. It's an asset account, and it is added to the investment account. So combined, the investment account shows $671,000. Then you add the fair value adjustment of 43, and then your net investment balance will be the $714,000, which is the fair value. When you're booking this entry on 12/31/27, under the available for sale investment, you debit fair value adjustment. This is the same way as we did for the trading security. However, when we credit gain on investment, which is an unrealized gain because we haven't actually sold this investment yet, except instead of going on the income statement, it's going to go under other comprehensive income. As a refresher, back from chapter 4, we learned about other comprehensive income. And just like our net income is closed out to retained earnings at the end of every period, other comprehensive income is closed out to an account called accumulated other comprehensive income, which is also on our shareholders' equity section of the balance sheet. So why is it for available for sale, we book this this unrealized gain in this situation? It could be unrealized loss depending on the way the fair value goes each period. Why do we book it to an OCI, an other comprehensive income account, rather than a regular net income or income statement account where it affects our income statement? Well, the reason for that is the available for sale securities are likely to be held for multiple reporting periods, whereas the trading securities are not. They're very short term. So including the unrealized holding gains and losses in income, if we were to report it on the income statement each period, it could confuse investors by making the income appear more volatile than it actually is over the long run, because we are planning to keep this investment probably long term, for sure longer term than a trading security. So this way it kind of evens out the income statement. It doesn't make your income fluctuate, but we're still recognizing the investment at its fair value on the balance sheet. I want to take you through this. It's the same example, just I put it into a Word doc. And the reason for that is because the book highlights some adjustment, but they kind of skip over some steps, and I don't think it's very clear as to what exactly happens. So here is what we just went through. You know, we have on 12/31/27, our amortized cost is 671, fair value 714. We need an adjustment to the fair value, and here's that debit to fair value, credit to gain on investment in the OCI balance account. So let's just, I'm going to put these entries into a T account of what we just went through. So we have our gain on OCI, which by the way is a temporary account because we do close it out to the accumulated OCI at the end of every period. But in this situation, we had a debit to the fair value for 43,646. Right? This is to adjust it at year end of 12/31/2027. So we had 43,646. That's the entry we just went through right here. What happens at the end of every period, and we'll just call it year end, is we have to close out this OCI gain gets closed out into the accumulated OCI account. So let's see if I can just make this into red. So on year end, right? Let's see, year end, we're going to book this closeout entry, and I've highlighted it in blue, and we're going to debit our OCI account 646, and we're going to credit our accumulated other comprehensive income, and that's going to be on our statement, our shareholders equity section of the balance sheet. So as of 12/31/27, right, I'm going to write 12/27 on here, accumulated OCI has a credit balance of this 43,000. Now moving on, we're going to assume that Masterware sold this bond for $725,000 on January 5th, 2008. So it's the following year. So now we're going to look, our latest amortized cost is $671. That's our latest balance that we have amortized so far. It's still the 12/31/27 balance. Now on January 5th, on 1/5/08, I don't know why it's doing that. Our balance is $725. So our fair value adjustment balance needs to be 53,703. So we already had a fair value adjustment. Actually, I don't need this part. If we just go up here, right in here, this is the fair value, this is what we're looking at. We had a debit balance of 646. We're going to go back, and now we need the balance to be 53,703. That's what we need it to be at 1508 when we adjust the fair value to its accurate balance on that date, on the date of sale. So then we're going to book just an adjustment to the fair value for 10,057. So we're going to book this entry right here. We're going to need 10,057 is going to be our debit to fair value, right? And now we're going to credit the gain account again for 10,057 to make our journal entry. That's our journal entry on 1508 right here. This is what we're looking at right here, okay? Now, before we record the actual gain or loss on this investment, because we actually sold it, I'm going to show you how we also are going to transfer out, we're going to close out this OCI to the accumulated OCI, okay? So what's going to happen right before we record the actual gain journal entry, we have to close this out. So we're going to close this out again because this is a temporary account. So we're going to debit our OCI account 10,057, and we're going to credit our accumulated OCI for 10,057. So now we have a balance in our accumulated OCI for 53,703. Our temporary account, our just regular OCI, is 0, and that's what it should be. And what we're going to do is we also need to close out our fair value adjustment account because we don't need it anymore because now we have sold our investment. And so what I'm going to do is I'm going to pick purple. Here we go. And I'm going to credit my fair value for this amount. So I'm going to credit fair value adjustment for 53,703. And my debit is going to be my accumulated OCI. It's going to be the 53,703. And so therefore my accumulated OCI is 0 and my fair value adjustments are 0 at this point. The reason for this is if I don't book this entry, then when I book my actual gain, my realized gain, which will go on my income statement, I would be double counting this gain between my OCI and my regular net income, and I don't want to do that. So that's the entry that happens right before we sell it. So I kind of put that right here, this debit of accumulate OCI and credit to fair value adjustment. And then we can go back. You can see our OCI is 0, our fair value adjustment is 0, and our accumulated OCI is 0. Now we're going to go back to our slides and record the actual gain on this sale as soon as it pulls up. Okay. So here's our actual recording of the gain on the sale. We sold it for $725,000. We received cash for $725,000. When we originally purchased this investment, we had debited investment for $700,000. So now we're going to credit our investment for $700,000. Our discount amount on the bond that's left yet to be amortized was $28,000. So we're going to have debit that. Again, if you don't know where this number came from, please go check out the effective interest method video. And so therefore our gain, right, this is really a plug, is 53,703. Now notice this gain goes on NI's net income. That's on our income statement. This is actually a realized gain. So we had to book those other entries to close out the fair value, OCI, and accumulate OCI, because now we're actually going to record this gain, and we don't want to double count a gain anywhere. Let's talk about an impairment of the investment, of the available for sale investment. And companies need to look at their investment and see if they need to be impaired, which means that the investment needs to be written down or decreased. If the fair value of the investment is less than the amortized cost, then an impairment exists. That doesn't mean that a company will necessarily have to write it down. It means the impairment exists. So let's look. So if fair value is less than amortized cost, then impairment exists. I like to see it. So if my fair value, let's just say, was 90,000, but my amortized cost is 100,000, then we need to look to see, should we write this asset down to 90,000? Because right now it's on our books for 100, and do we need to write it down to 90? So if the manager, so do we do that? Depends. If management intends to sell the investment, or it believes it's more likely than not that it will have to sell it before the fair value recovers, which means before the fair value increases above the amortized cost, then the investment should be written down and an impairment loss is recognized in net income. If management does not intend to sell it or doesn't believe that's more likely than not that the fair value will recover, then management does not have to write it down, but they do need to set up an allowance for credit losses, just like we did with a trading security. So think of the accounts receivable with an allowance for doubtful account. This is kind of the same thing. You're going to have your investment number at a certain amount, and then you're going to have your allowance for credit losses decreasing that amount, and then you're going to have your net investment. So that's only if management is not planning on selling it, and it does not believe that it is more likely than not that they will have to sell it before the fair value recovers. Okay, let's go over the financial statement presentation for the available for sale. The unrealized holding gains and losses are shown in OCI in the periods in which there are changes to the fair value. So any changes to the fair value, we book unrealized gain or loss to OCI, and then at the end of the period, they're reclassified out of OCI and into accumulate OCI. But once the securities are sold, that's when the gain or loss is actually recognized in net income. The balance sheet, the investment in the available for sale securities reported at fair value. And what does it say? Unrealized holding gain losses become part of accumulated OCI, and then the reclassify of OCI in the periods in which the securities are sold. So we went through that in the example. And the cash flow statement, when you buy or sell an available for sale security, they are classified under the investing activities. Let's look lastly at the actual financial statement presentation for 2027 and 2028. So for 2027, for the 12/31, for the 7/1 through the 12/31 period, we recognized interest revenue for $46,000. That was in the video we went through it for the effective interest method. And then we had this gain. So that's for net income. We had $46,000 for net income. We had this gain on investment unrealized that went into our other comprehensive income for $43,000. So our total comprehensive income, when you take the net income plus OCI, is the sum of those two to $90,000. Looking at the balance sheet, you have your assets stated at the fair value of $714,943. let's look at the shareholders equity section because it's a little different than the other ones we've looked at before. And this shareholders equity section has two accounts. It has the accumulated other comprehensive income. So right here, our total OCI that we have right here, that one goes right in here into the accumulated. And then our actual net income from our income statement, the 46, that one goes right into the retained earnings. Okay, so our shareholders equity has two accounts in 2027 that have a balance. Statement of cash flows 2027, during our first interest payment, well, we received 42,000, but we also, which goes into our operating activities, we also paid for this investment 666,000, and that's cash outflow from the investing activity. Now 2028. In 2028, we sold, right? We sold it on 1/5/28. We sold this investment. We have in our net income, we actually have a recognized gain on the investment. We recognized $53,000 gain. We also had to true up our fair value adjustment, and the way we do that is by booking it to a gain in the OCI section for the 10,000. So that's how we had total OCI of 53,000. Then what we're going to do is basically this statement presentation shows the 10,000 will be reclassified into the accumulated accumulate OCI, and then the accumulate OCI gets closed out by 53,000 to the fair value adjustment. And you can go back and look at all those journal entries, but this is how we get into that the accumulated OCI count is 0 at the end of the 2028, or actually it's January 5th, but if you're looking at the end of 2028, it'll be 0. And then when you look at our assets, they're also 0 because we were able to close out the fair value adjustment at that same time. So please go back to the earlier example in this video to see how these all zero out. Our retained earnings, which is from our net income, is going to be our, let's just erase all these things to make it a little bit more easier to follow. Our retained earnings of 100,000 is going to be the prior year income of 46 plus the current year gain of 53 equals retained earnings 100,000. And then we sold this investment and we received 725,000, which is a cash inflow in the investing activity section.